Question 30. Let's use this question to practice all the consolidation entries we have learned so far. To solve this question, first, let's prepare the allocation schedule of the subsidiary acquisition date fair value. Okay, so this is the schedule I prepared. In this schedule, the first is the fair value of the 90% controlling interest. The total amount is $657,000, and the 10% non-controlling interest has a fair value of $73,000. Both numbers are given in the question, so the total fair value is $730,000. Next, the book value acquired. This number is not given directly, so we need to figure it out by ourselves. And here is how I get this book value. So the total book value acquired equals to its retained earnings on the acquisition date plus the common stock. So the common stock balance is given in the question, $150,000. The question is, what is the beginning, or what is the retained earnings on the acquisition date, which is January the 1st of 2017, which is not given directly, but we know the 2017's ending retained earnings. We also know the 2017's subsidiary net income and dividend. So based on the basic formula to calculate retained earnings, so the ending balance of retained earnings equals to its beginning balance plus net income and minus dividend. So in this equation, only the beginning retained earnings is unknown. We do know the retained earnings of at the end of 2017, which is the retained earnings at the beginning of 2018. So we can solve this equation and get the beginning retained earnings, which is $740,000. Okay, and then we use that plus the total common stock. We get the book value acquired, which is $620,000. Alright, so then the excess fair value over book value equals to $110,000. So it equals to the difference between $730,000 and $620,000. Next, we're going to allocate those excess amount to those account which have different fair value from book value. The first one is equipment. It's undervalued by $20,000, have 4-year remaining life. So each year there is going to be a $5,000 excess annual amortization. The second one is the liabilities. It is overvalued by $40,000. See whether it's overvalued by $40,000. Equipment, liabilities. Okay, liability is overvalued by $40,000, and it has 4-year remaining life, which means that every year there's going to be a $8,000 excess annual amortization. So here we use interest expense switch. And the last one is the brand name. It's not recorded, but it do have $50,000 fair value, and assume it has 10-year life. Then each year there's going to be $5,000 excess annual amortization. So in total, there is $18,000 excess annual amortization we need to consider, which is going to be related to the subsidiary net income every year. Okay, so this is the step 1, the allocation schedule. Next, let's have a look at some of the consolidated entries. So start with those inter-entity transactions, and there's a inventory transfer from Kirby to Moore. So Kirby is the subsidiary and Moore is the parent, which means that this is the upstream transfer. Okay, so this is the upstream transfer. And in 2017, so let's just prepare the entries for 2017, and it's going to give us numbers we need for 2018. So in 2017, we prepared the entry TI. TI is we use this entry to eliminate the inter-entity sales, so debit sales and credit cost of goods sold, $45,000. The next entry is entry G. We use entry G to defer the gross profit in those unsold inventories. And the amount is $87,000. it equals to 30%. So 30% is the gross profit margin, which is given directly, and use 30% times the 20% of the total inventory transferred. They give us $8,700. $8,700 is the gross profit we will defer to the following period when it's actually sold. Okay, so in 2018, assume all the inventory are sold out, and we debit return earnings and credit cost of goods sold of the amount in entry G of the last period, $8,700. And this return earnings actually return earnings of Kirby, the seller. So update sellers return earnings. And next one is another entry TI. So this is entry TI for 2018 because they have intra-entity sale inventory transferred every year, and still we use this entry to eliminate the intra-entity sales amount, which is 160,000 debit sales credit cost of goods sold. And then we have entry G at the end of 2018 to defer 2018's unsold inventory to the following period, defer the profit in those unsold inventories. So which is so in 2018, the gross profit margin is 40%, and 20% of the inventory not sold out. So they give us $12,800. That's the amount of the interest we have to, amount of the profit we will defer to the following period. Alright, so that's entries related to the intra-entity transfer of inventory. Let me check it. Oh, sorry. There's one mistake I just made. So this 20%. So this 20% is the gross profit margin. Gross profit margin is actually 20%. Okay, so that's we need to correct that. 20% gross profit rate. Okay. But it doesn't impact the numbers. And so it just means that here, which means 30% of the total inventory left, and here is the 40% of the inventory left. Okay, so next let's have a look at the intra-entity buildings transfer. So buildings is sold from, let's see. Okay, so here Moore sold Kirby a building. So here parent is a seller and Kirby subsidiary is the buyer, which means that this is a downstream transfer. This is a downstream. And the entry would be in 2017. We used entry TA to eliminate the gains due to this intra-entity buildings transfer. So we debit gain on sale of 15,000, and because here we know how much is accumulated depreciation, so we use this whole entry serve two purposes. The first is to eliminate the gain, and second purpose is to recreate the accumulated depreciation that parent write off from its book when they sell it to the subsidiary. At the same time, we debit the building amount to make it to the 100,000 total. So the reason is that, so the book value of this building is 100,000, right? It has 90,000 accumulated depreciation. So after it's sold from Moore to Kirby, and both amounts have been written out from book, and its new amount for the building is going to be 25,000. So now what we are doing with TA is to first we eliminate the gain, and then we have to increase the book value of the building from 25,000 to 100,000. So that's why we debit building 75. At the same time, we credit accumulated accumulated depreciation of 90,000. So that is going to be, we create that back to our book. Okay, next entry is entry ED. So we use entry ED is to eliminate the excess depreciation associated with this overstated amount of the building, 15,000, because this building have 5-year remaining life. So each year there's going to be a $3,000 excess depreciation. So we eliminate that. Okay, then let's go to 2018. So that's the second year. So then we are going to have a entry star TA. So star TA, still we are going to use the star TA to eliminate those gains has been included close to the return earnings. So we debit 12,000 return earnings, and this is the parent return earnings, because after 1 year depreciation so new again, adjust again on the close to the book will be 12,000 left. And still we are going to have the buildings amount, total amount will be, we add buildings, debit building 75 to increase back to 100,000. And then this is more like, so we can plug in this amount for the cumulative depreciation. Our next entry is entry star ED. Star ED is the same as in terms of this journal entry, is the same as last year, because we are going to use the same amount, same account, and the same account and the same amount for it. All right, so I'm going to use next video to complete this question. Let's continue our consolidation entries. Next one we are going to prepare is entry star C. And the reason we have entry star C is because parent is not using equity method. And so how can we figure that out? By looking at the financial statement of the parent more company, we didn't see any investment income or investment income from Kirby. The reason is that if we look at the dividend declared by Kirby, it's 0. And that's kind of explain why there's no investment income. It's because Moore is using initial value method, and investment income equals to the dividend declared by the subsidiary, and right now it's 0, so it's not there. Okay, so if we know that the subsidiary is using equity method, then we need to prepare this entry star C with debit investment in subsidiary and credit return earnings. This is going to be return earnings of more subsidiary company, and the amount of this adjustment is 47,970. And how can we get that amount? And that amount is actually because it kind of tells different about the investment income. If the parent is using equity method, then the investment income would equal to the net income of the subsidiary company minus the excess annual amortization. Let's check the numbers over here. So 18,000 here is the excess annual amortization. That's one adjustment. And then minus this deferred profit. Okay, because this is upstream transfer, so this deferred gross profit related to the investment from subsidiary. And then the last is to minus what's going to be the investment income if the parent is using initial value. Is actually we need to minus the dividend declared. So here the dividend declared by the subsidiary is 0, so we minus 0, and we get 53,300, and because this parent only get 90% controlling interest, so we need to tap 90 as well. Okay, so that's how we get 47,970 as the adjustment amount for the control star C. So that's just to convert the return earnings to the equity method totals. Okay, so next entry is entry S. Entry S is to eliminate subsidiary equity account balance. So debit common stock and debit return earnings. So I use here S means a subsidiary, and common stock balance is 150,000, and return earnings adjusted balance is 541,300. It equals current book amount, and then minus this 8,700 related to the deferred gross profit in prior period. Okay, and then we're going to allocate 90% of the total debit to the investment in subsidiary and allocate 10% to the non-controlling interest. Alright, so that's entry S. Next one is entry A. So entry A is to adjust the subsidiary account back to its fair value. And we have 3 accounts here: equity, liability, and brand. And the amount here is 15,000 for equipment, 32,000 for liability, and 45,000 for brand. And this amount is actually equal to its original allocation and minus 1 year amortization or depreciation or interest expense, because this is beginning of the 2nd year. And still we're going to allocate 90% of the total debit to investment account and then 10% to non-controlling interest balance. And the next one is entry I. Entry I is to eliminate inter-entity income or investment income. But because in this question, the investment income is actually the dividend income, but the subsidiary paid no dividend, so we don't need to prepare entry I. And then as to entry D, so for initial value method, there is no entry D. And last one is entry E. So entry E is to recognize those annual excess amortization expenses, including interest and amortization or depreciation that's related to the equipment, liability, and brand. And all the amount here can be found in our schedules, in our extra annual amortization schedules. Okay, so that's all the consolidation entries. Next, let's calculate what's going to be the balance for non-controlling interest. So the first is what's the net income to non-controlling interest, because non-controlling interest have 10% and of the subsidiary company, so we use 10% and times the net income from the subsidiary company. It's going to equal to 40,000 of the current net income minus this 18,000 excess annual amortization expense, and then plus the deferred profit we recognize this year, and minus this year's deferred gross profit, and we get $1,790. And then this is net income allocated to non-controlling interest. As to the balance of the non-controlling interest, it's going to equals to the amount we already got here. So from entry S, okay, so from entry S, we allocate 10% of the book value to non-controlling interest, and then in entry, we allocate 9,200 of those fair value adjustment to non-controlling interest. So that's how we get these two numbers. And then plus net income allocated to non-controlling interest. And then we get annual balance of non-controlling interest, which is 80,120.